Asset-based finance is really about providing essential liquidity to Main Street. These are things that everyday people know quite intimately. So if it's the roof over your head, or the credit card in your wallet, or the loan that you took out for your family business to grow it, these are all things that people know and understand intuitively. But they don't quite realize that it's the bedrock of the global economy. We're packaging thousands of granular assets that are diverse from each other and packaging them into institutional grade transactions. And in doing so, we're creating a very interesting and unique stream of income that we believe is very uncorrelated to stocks and bonds.
Really getting investors access to a broad range of credit sectors away from traditional EBITDA or corporate credit. And we think that's really important in terms of getting investors both diversification away from traditional corporate credit, as well as a different source of investment pipeline away from PE-backed direct lending.
To sum it up, it's really about diversification, strong structural features, as well as cash flows that are uncorrelated to many of the other traditional private credit sectors.
Another huge advantage for TPG's ABF platform is that we invest across both the public and private space. And so if you're a non-bank originator, you want counterparties that can solve multiple problems for you, maybe not at once, but over the course of a relationship. And so having flexible capital both in the public markets and dedicated capital in the private markets makes us a much more unique and flexible counterparty than a lot of the upstarts that are focusing solely on the private ABF market, or the legacy players that are really just focused on the public ABF market. When we think about the landscape 5 years out, I think we would acknowledge that more credit managers will look to diversify into ABF, both as a source of growth, but as a defense mechanism from what we're seeing occur in the traditional direct lending landscape. We think they'll find it's a lot harder market to penetrate, given the barriers to entry like infrastructure, tenure relationships, and just the overall complexity premium. Within asset-based finance, the underwrite is really predicated on understanding a large amount of data. And so we like to say this business can't be run out of Excel. And so we've been refining our investment process all the way back since 2008 to today, incorporating new sets of data, new technology. Obviously, AI is first and foremost today. And that all comes down to being able to get the data, process the data, and then knowing what to do with it. And you can't build this infrastructure overnight.
What's really important there is that with the experience of the team, coupled with the analytics and technology edge that we have, we can really create a ability to identify opportunities, as well as make sure that we identify maybe short-term market noises that's not really susceptible to structural shifts in economic cycles, and find opportunities to take advantage of those short periods of noise.
The core team has been at this for a long time here at TPG, and so we've lived through multiple mini cycles and major cycles like the GFC or COVID. It's important to be aware of where we are in both the economic cycle, but also in a capital deployment cycle. And you just need to be disciplined in knowing that there will be more opportunities, and not chase when covenants are weakening or pricing is tightening, and have an ability to just really step back, observe, and just know that there'll be opportunity coming on the other side. And we've been able to display that really over our long tenure here at TPG. One of the sectors that we think is very compelling and that I think the market knows us for is the residential mortgage space. Today, you'll hear a new term called the lock-in effect, which effectively is just stating the obvious of a lot of US homeowners have locked in extremely low 30-year fixed rate interest rate on their mortgage. That means they never want to give up that low monthly payment. At the same time, you've seen home prices enjoy a pretty strong, consistent rise going back to the early 2020s. And so one of the opportunities that we're really exploring today and have been a leader in has been the evolution of the second lien market, where people are locked into their first mortgage but want to tap the equity that they have in their homes, typically to do things like improve the value of their home, put in a new kitchen, add a swimming pool, etc.
What we really like about that product is the underwriting standards are very tight compared to what we've seen historically in the HELOCs and second lien space. The borrowers themselves have been in their homes for a decade plus because they've been in their first lien mortgages, and they are responsibly using the cash out component of the HELOCs and second liens to actually spend that capital on things like home improvement, where it actually increases the value of the homes themselves. So if you look at the credit profile or the LTV profile of these HELOCs and second liens, what you typically see is that the borrowers typically have 30 to 40% of equity below your second lien position, which gives us a lot of comfort in terms of any softness in the housing market.
But with all of that embedded home price appreciation they have in their house, their combined loan to value with their first is pretty low. It's about 65 to 70%. That's actually inside of where first lien mortgage is. This is certainly not your GFC era second liens that had 100% LT loan to values or north of that.
I would say that the second opportunity that we find very attractive is really due to the imbalance of supply of homes and demand in the U.S. You know, we've gone through decades of underbuilding since the global financial crisis, but this particular opportunity really attaches to a different part of the value chain within the residential credit market. These are lending facilities or lending programs to residential developers, where if you think about the imbalance of supply and demand that exists today, as well as the lock-in effect where you're not seeing existing inventory come out to market, it creates a very strong environment for new construction. And that's what residential lot development financing really does.
One of the most compelling opportunities in ABF has been in the commercial real estate sector in CMBS, commercial mortgage-backed securities, particularly in SASB, single asset, single borrower, where we have really good structures, we have good asset transparency, and we have an advantage. We're able to be selective. There's a lot of dispersions. It's very much the haves and have-nots in commercial real estate. We have asset transparency. In CMBS, we have very good structures and good protection. But understanding the local markets is very important. Understanding the demographic trends, understanding supply constraints, understanding return to office. That's key in getting it right and being able to choose the right credits at the end of the day. If you think about the CMBS, the commercial mortgage-backed securities market over the last 4 or 5 years, it was probably the most dislocated market in all of ABF, and frankly, probably in most sectors. And a lot of that was driven by the looming maturity walls. You read a lot about that in the headlines and the press. That's largely behind us at this point in time. Now, you also look back at higher interest rate environments over the last few years, where sponsors have proven their ability to perform and operate their businesses and their buildings through higher interest rate environments. There's a lot more comfort around that, which has naturally led to more participants coming back to the market, willing to take more risk. And we actually saw in 2025 a banner year for single asset, single borrower issuance in the CMBS market, and we expect to see that or even greater in 2026.
The digital infrastructure asset class within ABF has been growing quite rapidly. If you were to rewind back 5-10 years ago, there was virtually no new issuance in the space. As you can imagine, everything we read about today, whether it pertains to data centers or fiber financing, a lot of this was done privately and was not nearly at the size that it is today. The ABF market has been leading in terms of the financing for these asset classes. There are very predictable cash flows that the ABF market can underwrite, and we have seen quite a bit of issuance come into the liquid side of the market in the CUSIP business, where we have been participating.
The second space where we actually play a pretty big role in it is the fiber. So think about people focused on building those big, huge warehouses that are holding all the servers. Well, how is that demand getting to the homeowner? It's through fiber, generally underground. And that's a space that we find to be a little bit less competitive, but we think has a lot of the tenets of ABF in terms of lots of large numbers in terms of the borrowers and the passings to homes. And we think that infrastructure need is really not as well covered in the mainstream media. But at the end of the day, the consumer wants that access to high-speed internet. And we think the ABF market is what's really financing that growth.
We believe the digital infrastructure space will continue to grow. We have been most active so far on the fiber side of the business. We've done a lot of work on the data center side as well, but have been rather slow to deploy, and that has not been by accident. The need for capital, the size of these projects are really tremendous. Initially, the banks have been able to step in for that financing and have really taken the first slug. As some of these projects get larger and larger and banks have been filling up, there's a need for capital formation around this space. We believe there will be a place for us to play. There's two ways to think about it. You can either play on the construction side of the space, where you are really shorter duration capital lending to construction until you have a hyperscaler offtake, or you can play it from the more stabilized cash flow, longer tenor perspective. We have so far gotten more comfortable on the shorter duration side of the space, and I expect that's where you'll probably see us play first. There are a few reasons that the IG ABF space has been growing and we believe will continue to grow. It's partially driven by the fact that we are seeing some bank retrenchment. Banks are pulling back in certain areas, and we do find that they are trying to lend to more simple cash flows and asset classes. Anytime that there's a bit of complexity, it really opens up the opportunity for private investment grade to step in. And the reason is that when you have that stable insurance capital that can lend against good assets, but you can be creative and nimble in the way that you think about structuring and analyzing cash flows, those opportunities oftentimes are a better fit for the private space than they would be in the public space where it's more cookie cutter. Now that our investor base has grown with a lot of insurance capital, we've thought about that risk differently, and we've thought of new ways to feed some of our partners the risk that they're ultimately looking for. That really started a couple of years ago via some co-investments that we did. When we started getting a better understanding of what these insurance companies were looking for, we were really able to customize what we were seeing and customize a product that would fit their balance sheet and fit the profile that they were looking for much better.
As insurers come to us looking for ideas on how to diversify their asset mix away from corporate credit, one of the spaces that we find extremely compelling from both a spread and credit perspective is residential mortgages. It's a huge addressable market. It's extremely scalable, but it requires a tremendous amount of operational heft. And so one of the things that we offer our insurance partners is an ability to plug into our infrastructure. We've bought over $25 billion of mortgages dating back to 2013. We built out an entire suite of proprietary analytics, due diligence, and asset management tools that allow our insurance partners to leverage our infrastructure, not just our sourcing, but also our ability to help them with due diligence, asset management, and even pledging those assets to the FHLB.
Within the private investment grade space, what we have found as we've been ramping up some of these portfolios is that we're able to originate risk that these clients are just not able to find in the public markets. These cash flows, these companies that we're lending to just aren't available in the public markets. Because of the experience that we have in the market, the work that we've already done on some of the very credit sensitive parts of the capital structure, it's just easier for an end borrower to work with us directly. They don't have to do as much coaching. They don't have to teach us the asset class.
That's an extremely attractive proposition for people looking for investment grade capabilities that aren't competing with them in their core businesses. And I think that's really been evidenced by our landmark transaction with Jackson Financial earlier this year, where we were able to get a really long-term partner to sit side by side with us as we explore the opportunities within private ABF, and we're really excited about it.
The consumer has remained incredibly stable throughout this period of volatility, but we are starting to see some effects wear down that stability. If you go back to what happened during COVID and all the stimulus money, the excess savings that we saw in the consumer balance sheet is certainly starting to wear down. We hear a lot today about a K-shaped economy. I think that can mean a few different things, and I don't think that pressure on the consumer necessarily means that we need to pull back entirely from consumer lending. It really means that we need to think about what aspects of consumer lending are we willing to attach to today, given what we see on the horizon.
Obviously, within ABF, we're not thinking about software companies that are being disrupted, disintermediated. We are thinking about the effect on jobs, right? And so when you hear a lot of people talk about the K-shaped recovery, that's something we generally agree with and sign on to, but we're trying to think about a few steps ahead of, well, what is AI going to disrupt first? Is it going to disrupt white collar jobs or blue collar jobs, right? And there, I think we are trying to lean into forward common sense almost of what asset classes, what types of credit profile are we looking to invest in that we think are just more durable cash flows from a consumer credit perspective.
In essence, places that we're focused on in terms of moving into a K-shaped economy is higher credit quality assets like residential credit, as well as essential consumer products like credit cards.
We build every deal to make sure we have the collateral and the transaction that's robust enough to survive economic cycles. And we would rather miss a deal than to compromise on that risk.